Okay, so hi everybody, good evening. So welcome to tonight's webinar, Reading Market Volatility, Insights and Strategy with the VIX. My name is William and together with me is Mr. Jose. So I'm the host for tonight. So before we start, I just want to do a quick check if you could hear me clearly and see my slides. If you could, maybe you can drop a one in the chat box. You can write anything in the chat box so that I know you can hear us loud and clear. So, okay, great. So thank you guys for the response. So here's just a disclaimer that for whatever we share tonight is just for general information and educational purposes. So it does not constitute to any recommendation to buy or sell any investment products. And this is about a little bit background regarding our company. So our company is called Phillip Capital Sdn Bhd, and we are incorporated in year 1995, and the company has been for over 30 years now. And we are only owned subsidiary of the Phillip Capital Holdings Sdn Bhd. And some of you may know we were formerly known as Phillip Futures, but as we grew and expanded our services and offerings, we have since renamed ourselves as Phillip Capital. Apart from that, we are also trading participants of Bursa Malaysia Derivative, participating organization of Bursa Malaysia Securities Berhad, and also a holder of the Capital Market Services license, which means that we are a legal and regulated broker in Malaysia. So Phillip Capital has offices across Malaysia. Our mother company is from Singapore, and for Malaysia, our HQ is in Kuala Lumpur. And we have total of 11 branches across both the East and West Malaysia. So if you are from any of the city, you are welcome to drop by our branch and inquire about investment-related services. And this slide shows that Bursa Excellence Awards that we received on last year, and we were also very honored to be awarded as champion for the best derivative trading participant and second runner-up for best overall derivative trading participant. So thank you to all our clients here because we couldn't have done it without you. And this is our global network. So Phillip Capital has a wide global network. We have office in 15 different countries as located here in the map. As such, we also do serve an international client base. And this is our global coverage. So we provide products listed in the global exchange from the US, like the popular exchange like CME. And we have CBOT, COMEX, and these NYMEX, NYSE, and NASDAQ. So we also have exchange from Europe, Japan, Hong Kong, Singapore, Australia, and also Malaysia. So with our global coverage, the clients can track both local and foreign products with us easily. And this is our products on a quick glance. So we are offering three main categories. The first one is the futures, and which include diverse market like the index futures, agricultural, metal, energy, and cryptocurrency futures. All right. The next one is the equities, and means you can trade Malaysia shares, US, Hong Kong, Singapore, and Australia shares with us. Followed by the third one is the CFD, the contract for difference. So we offer both the Bursa shares and also the US shares CFD. If you want to trade the US indices itself, like the Dow Jones, S&P 500, and also the Nasdaq, we also offer the CFD indices at very attractive rate. So if you would like to take advantage when the market is going down, derivative products such as future is a great choice because you can short the market and potentially make a profit as well. So essentially, it means you can trade both ways when both the market goes up or down. So this one is so why will you choose us as your broker? So first, Phillip Capital is an award-winning multi-asset broker. So we are well established and also recognized in the market. Second, we also offer 24 hours broking and execution support. If you have issues regarding your trades and account, you can call in our dealing desk and we have dealers ready to assist you. And the third one is that we also provide advisory services on what products you would like to trade or how you can get started. And we also send out latest market news to our clients on daily basis. So you can be sure to get the latest updates with us. And as mentioned earlier, our clients can trade a wide array of products through our platform. And lastly, there's no platform fee. So you will be able to access to our platforms if you have an account with us. And other than that, we also offer this one-to-one coaching. So for the coaching session, right, it's more like tailored for beginners who need some guidance on these topics, like how to start trading and regarding the product knowledge or platform or any charting system that you are interested. So our dealers will be more than happy and ready to assist you. So just contact any of the branch and look out for the dealers. Okay, moving on, we also have this weekly market call. So we also conduct this weekly market call, so you can join our research team on the market views and update for newly published report every Monday on 11 a.m. So if you want to learn more on technical analysis, like how to spot the entry and exits, right, then this is for you. And our technical analysis, our technical analyst, Mr. Jen, will do the technical analysis on live counters on every Monday night at 8 p.m. So this is the QR code. So if you would like to, on Philip Capital here, we constantly provide educational resources for investors. So you can check out our upcoming seminars and webinar by scanning this QR code. So on alternative, you can also visit our website at philip.com.my to check out the schedule. So we invite speakers from the industry to give market updates and insight. So it is a good learning opportunity, I would say. So do join us for our events. And this is for the online account opening QR code. So you can open your accounts for futures, stock, and CMD with ease and convenience because you can do it online now, even at your home. So if you do want to open an account, you can just take a screenshot or scan the QR code right here, and it will take you directly to the online application website. Okay, moving on in 3, 2, 1. Okay, so this is a quick view on our trading platforms. Sorry, hold on. Sorry, some technical issues. Okay, sorry, I'm moving over a bit. Okay, so basically now onto our trading platforms. So the platform that we use for futures trading is called Philip Nova, and it's very simple to use. So we also have mobile app for iOS and Android devices for those who like to trade on the go. So our platform is equipped with a wide range of technical indicators and market depth trading tools, so you can access to both the local and foreign products. So we also have live market news, and if you have any questions, we have Nova trading assistants always ready to assist you. So if you are not our client yet and want to try our platform to see the interface, we also have a demo account for you to try it out. And this is the trading view. So our live charts are powered by TradingView, where you can trade local and foreign products in one account. And we offer 15 global exchanges like SGS, Hong Kong Exchange, and then Japanese Exchange. And we also offer 24 hours broking execution support. So you can sign up for a demo account to try out. And for stock trading, the stock platform we are currently using is called Points. And our platforms all in one stock. So we have this all in one stock watch list, and then we have all these basic charting indicators, and then the exchange top 30 movers, and some stock analytics and market depth. And for the next one is this one is if you are someone who is interested in trading major US companies like Nvidia, Apple, Tesla, Microsoft, so this is a good time to take this opportunity as we are offering a highly competitive rate of just 0.02% or minimum USD $3.99 for US shares and ETF. And on top of that, you will get free access to live US market data, and there's also no platform or any custody fee. And we are also having a weekly market calls, which perhaps you can give some insights and updates on the key opportunities. And lastly, we're moving on into our promotions, the quick one. So here we comes to the promotion part. So if you are interested with trading the market volatility index after this session, we have this USD $3 per lot promotion up till the end of September this year. So you may request for free market data as well for this CBOE, VIX, and VSM products as well with us. So for more TNC, you may scan to the QR code to find out more later. And moving on to the next campaign, the promotion is that we have this grow your portfolio with CME micro futures campaign running until the end of this month, whereby you can subscribe to our CME products at only 2,000 ringgit Malaysia initial fund in with first trade buffer up to 100 ringgit. So on the other hand, we have here basis trading credit reward up to 88 to 288 ringgit this month until the end of this month. And moving on into this, the SGS Asian Index Futures, and this campaign is regarding whereby you can trade SG, Singapore, China, Taiwan, Japan, Vietnam, Indonesia Index Futures and under Singapore Exchange from as low as US dollar 1.88 only. And this promotion will end on 30th of June. And so you can also scan the QR code if you are interested to know more. So it will be ending on end of this year. And the final promotion will be the mini FKLI futures special promotion, whereby we are offering just 2.99 ringgit Malaysia commission per lot if you are trading this mini KLCI futures, which means that the this mini FKLI is that the Bursa they just launched at the end of last month. So aside from that, there's also a retail trading challenge where if you are ranked among the top 15 traders, you can win cash prize up to 8,888 ringgit. So this promotion is only for limited time, which is until 31st of July, which is this month as well. So if you are interested in trading this product, it's a good time to start, and you can also scan this QR code to find out more. So now, finally, before we dive into our topic tonight, let me introduce to you our speaker tonight, Mr. Jose, who is a seasoned trading expert with a strong background in derivative, digital assets, quantitative research, and risk management. So originally, he is an engineering professor. So he applies a scientific, data-driven approach to trading using statistical analysis, backtesting, and machine learning to develop systematic strategies. So he has also led to the creation and commercialization of proprietary trading tools, working closely with institutional partners with an MBA and CQF qualification. And he remains active in academia through finance lectures. So his unique blend of technical expertise and market insight tonight and practical business experience will allow him to bridge research strategy and real-world execution effectively. So we are very honored to have him on board with us tonight. So to seize the opportunities to ask him any question in the chat box, the chat box, you can keep the questions coming in. So at the end of the session, we'll be sending this question to ask Mr. Jose directly. So let us welcome to Mr. Jose. So, Mr. Jose, you ready? I will pass the screen to you.
Yeah, I'm ready. Thank you very much, William, for the introduction, and thank you everybody.
Okay.
Thank you everybody for joining us today as well. Yeah, so I'm just waiting to share my screen, and we begin immediately. I believe I need to be given presenter permissions to share the screen.
Yeah.
Very good. Here we go. So I believe that you should be able to see my screen. I would love to have a quick message on the chat box with a quick OK if you see my screen, or no if you don't see my screen. I believe all should be good, sound and screen. But we have a very rich session in front of us. I have so much to share, and we have limited time. So in that sense, it's important for me that you hear me well, you see me well, and also most importantly that you type your questions. Okay, I will be looking at the questions as you type. And as Mr. William just mentioned, we will have Q&A at the end too, just in case I missed anything. But please do not wait to type your questions until the end. As you have questions, please type them in. And I'm pretty positive you will have questions, because again, the webinar that we are doing today, the topic, it's not a common topic. We don't do too many webinars talking about VIX, something that may be new to many of you, and therefore you will probably have questions. So please work with me on that. And again, I would love to see that on the chat box. Also, Mr. William, I would like to confirm that the chat is activated for me from my end. So if anyone type, I can see it, okay, because I'm not sure that's the case at the moment. Anyway, so let's begin. We are talking about volatility, okay? We are talking about volatility. We are talking about the VIX. VIX, the V is for volatility, and IX stands for index. So volatility index, that's the VIX. So we need to talk about what's volatility, what's an index, and then most importantly, how do we trade it? Okay, how do we trade it? Which is going to be index futures. It's going to be VIX futures. That's going to be the answer to this question. Okay, but let's do things one at a time. Okay, So the first thing would be to talk about the difference between risk and volatility, because often I hear it all the time that when people have a conversation about the markets, they will say the markets are volatile, and next thing you know, people perceive that means the markets are risky. And that's not exactly what it means. And I want to make sure that we understand the differences, which are subtle but very important, because you will conclude out of this conversation that you could actually trade the volatility or use it for certain other benefits, like hedging a portfolio of stocks, for example. So again, we are about to have a very important conversation, but I need to rewind to the beginning and start with, an explanation of what volatility is. So I have a question for all of you, and I need an answer on the chat box, please. So the question for all of you is, would you agree with me with a yes or a no if I say no risk, no reward? That's the question. Okay, yes or no? Do you agree if I say no risk, no reward? Right? And I would assume that most of you would say yes to that, isn't it? As I can see. Okay, very good. So of course, no risk, no reward. It's obvious. It's fair, to be honest. Okay, and it's what it is. It's life. Okay, beyond financial markets, life is like that, right? So then, why do people look at volatility like it's risk? Actually, risk, based on what we just said, risk is not a bad thing, right? No risk, no reward. So a little bit of risk may bring some reward. So look, a little bit of risk may be a good thing. So why, when people think of volatility, they think volatility is risk, and immediately they think volatility is bad, right? Well, it's often because it's not well understood. And really what volatility does is very simple. It's measuring the variability of returns. And an easier way to understand that is to say speed. So volatility is a measurement of speed. And if a market is volatile, it moves fast. If a market is not volatile, it moves very slow and is very boring. And there is no opportunity because no risk, no reward. So risk and volatility are definitely interlinked, but they are not the same. You may have cases where volatility is very high and the markets are very easy to trade. And you may have cases where volatility is very low and the markets are very, very dangerous because there is no room for a profit. And then, again, it's a problem more than an advantage. Okay. So I want to get deeper into that by also saying that we actually have two types of volatility. Okay, and I need to explain that before I get into VIX and before I get into VIX futures and before I get into trading strategy to trade the VIX. Okay, so we have multiple steps to walk together. Okay, so we have two types of volatilities: what we call realized volatility or historical volatility, and what we call implied volatility, which is forward-looking. The realized volatility or historical is backward looking. Let me show you something. If I get into a chart and I get here the SPX, which is the S&P 500, okay, and I make sure that when you look at SPX, make sure you select CBOE, Chicago Board Options Exchange. We normally call it the CBOE. Just make sure you get the CBOE data feed, okay, because there are many S&Ps and there is only one, which is the real one, which is SPX. And here's the chart, right? And if I was to remove everything I have on the screen for a moment, and I was to add an indicator, this is, by the way, I'm using TradingView, okay? If I was to use an indicator which is called historical volatility, and I was to add that, here it shows me 9.56. So that's the backward-looking historical volatility of the S&P 500. I could do the same exercise with Bursa Malaysia, for example. So this is Bursa, volatility there, 10.22. Again, back to SPX, CBOE, and we get the number 9.56. So what does that number mean? Well, that number means that given the speed at which the S&P has been moving in the past, 1 year later, the S&P should be either up or down 9.56% if it remains moving at the same speed it's moved in the past. Okay, so this is speed of movement from the past, where if we project it into the future, it's telling us that 1 year later, you'd be up or down 9.56% in 68% of the cases, which is a 1 standard deviation. If you are into math and statistics, you know what I mean. If not, it's not too important at the moment. So 9.56% up or down. Notice I said up or down. It's non-directional. It's speed of movement. Okay, to reach 9.56%, you have to move faster than if the number was 5%. 5% is less, 9.56 is more, faster speed. And notice how the speed of the markets, okay, are not constant. The fact that is 9.56 now, based on the past speed of movement, doesn't mean it's always like that. Notice that there were peaks here of 26%. There are times where it drops to 6.83%. So again, the market sometimes accelerates, the market sometimes speeds up, but again, depending on when you measure, given the prior speed, so you would then be able to do a projection and conclude the market is likely going to be either up or down 9.56% in 1 year time. So this is historical volatility, which I would say is interesting. I would also say, if you don't mind me to be a bit direct with my words, hopefully you don't, it's a little bit of a waste of time, right? Because it's already happened and it's changing, and I mean, who cares? I mean, it's a good way to know what you got in your hands. If you let's say you trade a market with a volatility of 75%, so that means it's probably a crazy market because it can move up or down 75% in 1 year. Probably a bit too much. Maybe gives you a heart attack, isn't it? Maybe if you trade a market which is moving like 2% a year, maybe it's better to put your money in a fixed deposit and forget about it, isn't it? So again, it's a good way. It's an interesting measurement to look at the historical volatility, even though it's not going to help you to trade better. And by the way, you cannot trade historical volatility because it's already happened. It's in the past. So the really interesting one, and that's what the VIX is made of, is the implied volatility. That is the real thing. So what is the implied volatility? Well, for that, I need to give you a crash course on options trading. So speed of the light crash course on options trading. I'm going to click in here, and I am loading options for the S&P 500. And notice that even though we don't have time really to talk about options properly, notice how we have multiple expiration dates, July 16, July 17, multiple July 17s, 20, 21, 22, 23. So we have multiple expiration dates. And if I pick one, whichever I pick, I have many what we call strikes. So you have the 75.50 option, the 75.55 option, the 75.60 option. And then on the left, we have what we call the call options or the calls. And on the right, we have what we call the put options or the puts, which again, I cannot really explain this today. We don't have time. But I just want you to know that those financial products exist, and they are extremely heavily traded. Okay, very, very heavily traded, and people pay for them. Okay, people pay for them a certain amount. For example, if you were to buy the 75.6 option, you would pay $35 plus. Let's call it $35, $30. Okay, that would be what you pay. And if you think about it, if you're gonna pay for something, it's because you have a certain expectation. Let's say you expected that the S&P is likely going to move so slow that it's going to do nothing to this year. So would you be willing to pay $35 for an option? Probably not. Probably you will want to pay much less because you expect little. So then you are only okay paying little because you expect little. Let's say you expected for the S&P to move very fast. So then, of course, you would not mind to pay 35 because you would expect maybe the S&P to move by much more than 35, and therefore paying 35 will not be seen as a big deal. So in other words, the prices of the options, which unfortunately I don't have time to get into today, but the prices of the options got what we call an implied volatility. The price of the option has within it, it's implied, it has an expectation for the future movement that does not happen yet. So it's forward looking, and let's face it, it's very complicated. If I was to If I was to ask you for you to understand the volatility in the market, if I was to ask you that you need to go and load every option that ever existed and look at all the expiration dates and all the strikes, you would probably go crazy. What's the good news? Well, the good news is that this is done for us with the VIX. When you load the VIX, and again, make sure you select CBOE, okay? So now you get a number here, which is 16.40. 16.40. That means that given the current level of options that asset managers around the world are paying, the implied expectation within the prices of the options, remember, if they expect more, they pay more. If they expect less, they only want to pay less. So given the current real-time prices of those options, we are now looking at an expectation for a future movement on the S&P of 16.40% in 1 year's time. And this is very interesting because the SPX, which is the S&P 500, it's currently moving at a speed of 9.56, okay, given what happened in the past. But if you forget about what happened in the past and you look at the current value of the options, which is the VIX, and you extract from the options prices the implied volatility, it tells you that the current level at which options are being bought and sold represent potential movement into the future, not the past, of 16.40%. In other words, options are expensive. The market is moving at a rate of 9, and options traders are willing to pay 16, a rate impacted by a 16% expectation into the future, which is much more than 9, which is the current speed of movement. So this is just touching on the tip of the iceberg of understanding a little bit of volatility. We need to dive way deeper into that, okay? So again, rewinding to the beginning of the webinar, which, as I said today, I may saturate you with information a little bit, okay? I'll try to bring this educational material one step at a time so you can digest it easily. But at the same time, today I have a lot to share. And going to the beginning of the webinar, first we talked about risk and volatility. What's the difference? And we agreed that no risk, no reward. Volatility measures speed. What type of speed? Speed in the past or speed in the future? Where speed in the past, we said, is realized, and it's interesting, but that's it. Whereas implied volatility, that's the VIX, and as you are about to learn, you can actually trade it, and you're gonna love it, okay? It's very, very cool. Anyway, so we'd love to get a little bit of feedback on the chat box, okay? If that's okay, if all is okay, just type okay. If I'm speaking a little too fast, or you need me to repeat something, or you have a question, please type it in. I really need your feedback because we are touching on something extremely powerful, but also very delicate today. And I want to make sure that all of you follow me. So give me some feedback here. Anyway, so now we looked at a level of volatility of 16, right? Out of curiosity, for the ones of you that like math, you can stop listening to me now if you don't like math. I'm just going to take 1 minute. But if you do like math, you will like this little trick. You take the VIX divided by the square root of the number of trading days in a year, which is 252. That's roughly 16. And that tells you the daily expected move in a percentage. For example, if the VIX is 20 and you divide it by 16, it tells you that the expected move for the trading day is either 1.26% up or 1.26% down. That's the expected trading range based on the prices of options. Today, VIX is 16, 16 divided by 16. So we are expecting a 1% move either up or down in the S&P 500 index, which is the underlying asset from where we take their options and we then are able to calculate the VIX, which is the volatility index, by using options on the S&P 500 index. So that's pretty interesting. Again, if you like math, so you just divide these by 16, and then you get the daily move. Okay, and that's one way to understand volatility as well, as a way to understand if the market is moving fast or likely going to move fast or not. Anyway, so far I'm just giving you, let's call it curiosities, okay, information which make you curious and may sound interesting to you because it is indeed interesting. But I cannot wait to get into how do we trade this. That's going to be the most important part of the day. So I'm going to answer. I'm going to give you a tip, okay, on just touching on the iceberg of proper answers I'm giving you coming in a moment. And the little tip of the iceberg I want to touch on is the little graph that we have here on the left that says that the correlation between the VIX and the S&P 500 index, SPX, is 78.5% of the times opposite. In other words, when the markets go up, the VIX tends to go down, and when the market goes down, the VIX tends to go up. So let's take a look. For example, SPX, SIBO, okay? We can see, for example, here we have a drop, okay? That started on June 2nd, okay? June 2nd all the way to June 10, something like that. So let's take a look at the VIX. What happened during that time to the VIX, June 2nd to June 10, and here we got June 2nd, okay, all the way to June 10, okay? Now, here's the beauty. When you look at the VIX and we do some measurements, for example, I measure the magnitude of the move from here all the way to here. So we are talking about 54% increase on the VIX. So that move was a 54% move to the upside on the VIX, where if I look at the move on the S&P, which was going down from those same dates, so we are talking about a move of 5% down. So in other words, the S&P went down 5% and the VIX went up 54%. So it's not only about the fact that it's negatively correlated, meaning that they move in opposite direction. It's also a fact, the fact that when people get panicky in the marketplace and they start buying options for protection like crazy, the prices of the options inflate by a lot, creating this very high implied volatility measurement, which is very, very beneficial for us. Think about this. Let's say you are a stock trader and you have a portfolio made of 25 stocks. And this could be stocks in Bursa Malaysia, or it could be stocks in the US, or it could be a mix of stocks across the board, across countries. So what happens typically when you have a very severe drop on the S&P? Well, I'm telling you, if you look at Bursa, if you look at China, if you look at Hong Kong, if you look at Singapore, all those markets are going down, isn't it? So what could you do? Well, you could buy the VIX. We're going to talk about how to do that with futures in a moment. But you could buy a few contracts of VIX while you remain holding your stocks. And as your stocks are being hurt at a rate of 5% in this example, with the VIX, you are making money at a rate of 54% for the same move. In other words, it serves very well as a hedge. Just a few tiny VIX contracts, depending on the size of your portfolio of stocks, may protect a stock portfolio in case the market drops. A few VIX futures contracts could protect that very well, because again, it's not only about the fact that those two markets move opposite 78.5% of the times, it's also the fact that when they move, the magnitude of the move for the VIX is lots more, and that it's very powerful. So again, touching on the tip of the iceberg for you to see things that we can do with the VIX, even though I'm going to show you more concrete and specific strategies in just a moment. But again, for you to trade the VIX, you have to trade futures. You cannot trade an index, right? You cannot trade the Kuala Lumpur Composite Index, KLCI. You cannot. You could trade FKLI, which is futures of the KLCI index, right? So you need futures contracts to trade an index. You cannot trade the S&P 500 index, but you could trade options or futures on the S&P 500 index. You cannot trade the VIX index, but you could trade futures or options on the VIX index. So today we're going to be talking about futures. which I would assume that a number of you guys may have traded futures before already, so you know what futures is all about. For ones of you that never traded futures, I'll give you a crash course on futures trading here. So I open your mind, and of course you can always rely on the team of dealers with Philip, and they will support you and give you access to educational materials and everything you need so you master futures. But basically, when you trade futures, you basically don't have to own the asset. That's a key thing. If you trade stocks, you have to own the stock. And for you to own the stock, you have to pay for it. But for you to trade futures, you don't have to own futures. You only come up with what's called the margin requirement, which is a limited amount, much less than ownership. It's a limited amount of capital that serves as collateral for you to be in a trade, and that money is tied up during the life of the trade. But you are not going through ownership, and therefore you don't need to pay the whole amount. We'll talk about margins in a moment, but it could be, as little as, $250. Again, it could be very, very small, depending on the contract that you trade. So that's one thing about futures. You avoid the ownership, and therefore you trade on margin, which obviously gives you tons of flexibility. Talking about flexibility, you can go long and short. Whereas with stocks, definitely in Malaysia, you can only go long. You cannot short stocks. So with futures, you can go long and short both, which is much more flexible and practical. And then you can adapt to market conditions by betting on volatility expansion or betting on volatility contraction, as I will show you in a moment. I didn't say, by the way, that of course this is CBOE, so it's the largest derivative exchange in the planet, and it's CFTC regulated. CFTC is also approved with Bank Negara and Securities Commission, just like Philip as a broker is also licensed under Securities Commission. So that's a very, very proper way to be exposed to those markets. And by the way, we have full-size contracts, which is called the VX instead of VIX. It's called the VX. But we also have the mini size contract, which is VXM, which is 10 times smaller. So you see, this is VIX, VIX. If I select CBOE, here you have, that's the VIX, okay, 16.44. We talked about this a moment ago. That's the index. You cannot trade this. If you want to trade it, you have to change VIX to VX, okay? And now under VX, you have futures, CBOE. And I'm just going to use VX1 exclamation mark, which is how it would be input in TradingView. If you use Philip Nova, for example, it's going to be slightly different, but it's still going to be VX. And now you got the futures contract, which, by the way, notice how the value is different. And we're going to talk about this in just a second. But the chart, you can see the chart is the same, basically, but the value is different. We'll talk about that in just a moment. So this is your futures contract. And if instead of VX, you type VXM, so now you're talking about the mini CBOE volatility index futures, which is exactly the same thing. But now, instead of the full size contract, you trade a contract which is 10 times smaller. And that means that every point pays you $100 instead of every point pays you $1,000. So again, going back to what I was saying before, if here, from here to here, right, you took a trade, let me highlight it the way I did before. So let's say you were concerned about your portfolio on June 2nd, and you got into VIX futures, and you collected a profit here with VIX futures. In this case, notice that with futures, you're going to have different values as well. So we got 32%, still way more than 5%. And also we have different futures expiration date, which I'll discuss in a moment. But basically, that 32%, okay, means that you collected 5 points. So from 16 to 22, that is 5 points. 5 points that per contract would have paid you 5 times 1,000, that is $5,000 per contract, or $500 per contract if you use the mini contract. Okay, and you can do this just by coming up with margin. With margins range depending on the expiration date for futures. Again, that the team of dealers with Philip will guide you to select the right expiration date, and they will confirm to you the margins. But the margins range between 2,500 to 8,000 for the full size contract, 10 times less for the mini size, which is 250, which is 10 times less than 2,500, right? So you can trade VIX futures or mini VIX futures for very little capital. And apart from do the things I'm about to show you, which are very cool, you can just, hedge a whole portfolio of stocks, for example, by buying a futures contract. Okay, so it's something that, as I said, the topic for today's webinar is not very common. You will not see many webinars that talk about the VIX. So it's probably something that for the majority of you is something new. But if it is something new, make sure you dive into it big time, because this is an extremely important asset that you could certainly very easily incorporate to what you already do in your trading, including if you don't trade futures and you have a portfolio of stocks. Well, now you know you can use VIX to hedge your stock portfolio, even though I'm about to show you things that I believe you will find even more interesting. Okay, but I'm not saying that this is not. Now, trading hours for the day, that's another great advantage of trading futures compared to trading stocks, which is the fact that this market is open 23 hours per day. So no matter what, no matter when, as long as you're awake, VIX futures is trading and you can go ahead and take a trade. Okay. The times that you have on the screen are Central Standard Time in the US, that's Chicago. So if we convert this to Malaysia time, that is 5 a.m. to 6 a.m. in Malaysia. VIX is closed. 5 a.m. to 6 a.m., which probably you are either asleep or about to have breakfast. So the moment you're done with breakfast, ready to trade the VIX all the way to 5 a.m. next day, right? So 23 hours of trading per day, which means that no matter if your concern is coming because something is happening in Iran and you get to see that impacting the stock exchanges in Europe, and maybe at that time the Malaysian exchange has already closed, like Bursa already closed, and you're going to do anything to maybe close some stock positions and things like that. You're going to do anything, well, you can definitely get into a VIX position. So if tomorrow when Malaysia opens, stocks in Malaysia are being hurt, or stocks you may own in the US are being hurt when the US opens later on, you are gaining some level of protection the way I described earlier. So again, very convenient. Look into it. It's very cool, and it's probably new to you. Now, instead of discussing this chart on the slide, let me show you that real time. I want to go back to VIX, and I want to show you two things here. So first of all, I'm going to zoom out for many years. And I want to point at, for example, Liberation Day, that was here, where during the Liberation Day, when Trump started with tariffs for everybody in the world, people thought the S&P would move at a rate of 60% a year. Then the year before, when Japan decided to start increasing interest rates, the world thought that the economies worldwide were going to, have an impact, and the world therefore started thinking that the S&P would move at a rate of 65% a year. The pandemic, where the world thought that the S&P would move at a rate of 85% a year, up or down. I mean, you can see that the VIX, by the way, also known as the fear gauge index, right? You may have heard that term before, which I really strongly dislike because it really doesn't represent fear. You could argue that when the markets are crashing and professional traders we are shorting the markets, it's not fearful. It's actually very exciting. It's the opposite of fear, really. But anyway, putting that on the side, I mean, I get it that, people were scared in the pandemic, people were scared with Liberation Day, and, the VIX goes up when those events happen, and then people call it the fear gauge, right? Fine. A very amateurish way to think about it, but, I'll take it. Now, having said that, notice the behavior. Every time people believe the world is ending, what happens next? Reverse back to the mean, comes back down. So every time the world is ending, no, it's not. Oh, the world is ending, no, it's not. The world is ending, no, it's not ending. The world is ending, no, it's not ending. The world is ending, no, it's not ending. And that's the typical behavior of the VIX all the time. So very, very, very important message. Okay, very, very extremely important message that you need to take home with you after today's webinar, and remember this forever. This is serious. Listen carefully. If you look at the S&P, or you look at stocks in general across the board in the world, most of the stocks will look something like that. It's an uptrend. Okay, stock indices will look in an uptrend. I mean, the US market is one of the most powerful markets in the world, as we can see, but most of them, they are a trending asset, which means that if you buy and hold for the long term, it could make sense. But what about the VIX? Would it ever make sense to buy and hold the VIX? It would never make sense to buy and hold the VIX. You would always end up in the same place, because even if it goes up, then it reverts back to the mean. So what I'm trying to say, and this is a big thing for you to remember, is that the VIX is an asset for you to use for convenience or for you to be opportunistic. You want to hedge a portfolio because you perceive risk, get into the VIX. Once the risk is gone, get out. Don't hold your VIX position for the long term. Use it for that protection and get out. Take the money and run. That's what this market is designed to do, because it measures volatility. It is not representing the fundamental value of what a company is doing and what they build in their factory and how much operational margin they have and their balance sheets and their PE ratios. It's not that. That's stocks. This is measuring speed of movement, right? So it tends to revert back to the mean. So very, very important message, that you get to see that even when people think the world is ending, guess what? It's not. Okay. So in this move, if you traded this move to protect your portfolio, you get in when you're concerned, you get out when you are no longer concerned. You keep your, let's say, $5,000 per contract, if that was the case, and you keep trading. Okay, but you don't hold it, for a month, for 2 months, for a year, because then you end up in the same place all the time. Okay. Very good. So now the most important part of the day. How do we trade this asset now that we know what is volatility, what is the VIX, what is VIX futures? And I just mentioned one tiny application, which is to protect a portfolio of stocks. Tiny application because it's very simple, but it could be massive for you guys, isn't it? With one trade to protecting a whole portfolio made of stocks of whatever country. Okay, so that's very powerful. But anyway, look, we talked about the VIX, mean reverts. Okay, the VIX tends to mean revert. We also talked about protecting a portfolio. So let me load VIX futures first. And now I am going to activate, some of the tools that I utilize in my trading. So what you can see here on the top is what we call UFOs, okay, on-field orders. And I apply this to the VIX, and notice how I rewinded the dates all the way to June 3. So let's say you are holding a portfolio of stocks, and you see the VIX is going down, going down, going down, going down, and it's about to come into a green UFO. So this is an area where you have buy on-field orders for VIX futures. So it's an area where buy orders exceed sell orders, where demand exceeds supply, and therefore if the VIX goes down, from there is likely going to go higher. So what can you do? Well, that could be the timing instruction that you give yourself, that when the VIX goes down, you buy VIX futures. If it keeps going down, you get out for a minimal loss on the VIX while your stocks kept going higher, because remember, if the VIX goes down, the stock market normally goes higher. So you made a profit with your stocks and you took a little loss with the VIX, fine. Now, if the market falls by 5%, your stocks are being hurt. Well, in the meantime, with a VIX futures trade, you made. I went too far with the fast forwarding. Here we go with a VIX futures trade. So you just made that 5 points movement to the outside, which helps you to protect a portfolio. So this could be one way on how to do it. Another way on how to do this is to use, for example, Bollinger Bands. I'm using just, in this case, generic tools available in every trading platform. And maybe you do these, just going to pick a 4-hour time frame, for example. Okay. So what do you do? Well, a Bollinger Band means, this is a crash course on Bollinger Bands. A Bollinger Bands basically represents a zone within the bands where the price should stay inside 95% of the time and be outside only 5% of the times. So what do? Every time price goes outside, you bet on a mean reversion, which is the blue line. It goes outside the band, you take the trade. It goes outside the band, you take the trade to mean reversion. It goes outside the band, you take the trade for the mean reversion. It goes outside the band, you take the trade for the mean reversion. It goes outside the band. This one was a stop out. This one didn't go out. You take the trade and you bet on the mean reversion. Out, bet on the mean reversion. Okay, out, on the way to mean reverting. Didn't get there yet, right? So it's a mean reverting asset, and therefore either using intraday timeframes like I'm doing, or using daily timeframes, or using even smaller timeframes. That's going to be your decision, your trading plan. You can certainly take advantage of this mean reverting behavior that other assets don't have. Okay, it's a very special asset that have a very specific way on how to behave because it measures speed. It's not an asset that represents the value of gold or the value of Bitcoin or the value of a company or a country. It represents speed of movement. Okay, and yeah, so that's what it is. So you can mean revert it and trade it this way very easily, or you can trade events. For example, let's say you are an intraday trader and you live in Malaysia, and your plan will be to find a way to have a trading methodology that gives you one trade a day, evening hours, after dinner, your kids are in bed, you are ready to focus on the market, take one trade and get in bed. Let's say that's what you're looking for. So good news for you. Almost every day at 8:30 p.m. Malaysia time, which is 8:30 a.m. in New York, almost every day, we have a very important economic report that comes out. Yesterday was PPI. Today, a moment ago, actually, as we are speaking, you can see the increase of volatility here as we're speaking. It was retail sales. Okay, but probably the biggest one, it's first Friday of the month, which this year was actually first Thursday of the month, because first Friday of the month they were observing a very important holiday in the US, which is 4th of July, which is the day of independence. So on Friday 3, the market was closed. Normally it's the first Friday of the month, but this month it was the first Thursday because Friday was closed. So on the first Friday of the month, you have the unemployment rate. This is one of the biggest numbers ever reported once a month at 8:30 p.m. Malaysia time, 8:30 a.m. in New York, once a month on that Friday. So let's say you want to trade news of that sort. So I'm just going to move to, just give me a moment. I'm just going to move to July 2nd and know that because SIBO trades in Chicago, 7:30 a.m. in Chicago is 8:30 p.m. in Malaysia. Okay, Chicago and New York is 1 hour difference. So let me go ahead and again just hide those candles so you got proper understanding here. Here we go, 7:30. Okay, I'm going to hide. Okay, and this is what you see before the economic report comes out. You have no idea if people will interpret the report as being good for the economy and people cool down and speed slows, or people get scared and then volatility increases. No idea. And because I have no idea, the only thing I know is the time. So what I could do is to wrap around all this area. Okay, I could wrap around a zone. Okay, a zone which you could make it the way I did it. Probably I would do it like that, but just to make sure I don't miss it, I'm just going to use all these sideways trading action because you have a drop and then nothing's happening, and now we are waiting to get the report on the next candle. Okay, the current candle is 7:20. This is a 10-minute time frame. Okay, so the next candle is when the news is reported, and therefore I don't know what's going to happen, but here's what I want to do. If it goes above, I want to buy. If it goes below, I want to short. I'm ready to take both directions. Okay, so how would I do that? I can get myself a Fibonacci retracement tool, for example, and maybe I can draw lines from here to here, and then I can just remove everything in between, and then I'm going to project a +1, and I'm going to add, I'll do it here, for example, a -1. Okay, so I'm just setting myself 2 targets, and of course everybody here has a different way to set targets, I assume, but basically, so this is the move. I got 1 target here, and I got 1 target there. So if it goes down, I want to short. If it goes up, I want to take a profit, and the extreme lines are going to be my target. And if I use the trade, the order panel here to plan on a short, so we get a few measurements. Okay, so if at that time I short at this price, this is my entry. Okay, and I add a stop located right there. Okay, so if it goes below, I short with a stop above. Notice that with the full contract, I'm risking $150. With the mini contract, it would be $15, 1.5. And then for my profit, I want to move it to where the blue line is. And this will be the trade. So I am risking 150 to make 315, which is a 2.1 to 1 reward to risk ratio trade in that particular case on that particular Friday. Okay, this is a type of setup that you could practice with almost every day, because as I said, almost every day at 8:30 p.m. you have an important report. Yesterday, PPI, July 2nd, it was the unemployment number, etc. Right? 8:30 p.m. Keep that in mind. So what happens next? Okay, the report is public. The market shows volatility. You have got filled short. The stop is above. You almost got hit the stop, but you didn't. So good one. And then it may reverse on you, or it doesn't, or it may get to the target, or it doesn't. So you just let it play. Here we go. So that was a trade that took 1, 2, 3, 4, 5, 6, 7 candles, 10 minutes each, 70 minutes. So a little over 1 hour, and you got your $300 of profit. And now time to go to bed. Okay. So this is one way on how the VIX could be traded to really, really exploit very nicely increase or decrease of speed in the marketplace as a consequence of economic reports. That is a very convenient thing to do, because it's very, very likely that the market will get some sort of a reaction to a relevant economic report. Anyway, we are hitting the top of the hour, so it's time goes very fast. So I have a few more comments, and then we'll talk about questions. So first of all, discipline is key. So everything I said during today's presentation, putting on the side, I love the VIX, and I recommend everybody to go ahead and study the VIX, educate yourself, look into it, find out more about the VIX, and so you can get ready to trade it if you choose to. Putting that I would certainly encourage you to do that, because it's a fantastic market that is not really well known, and people should know the VIX. Putting that on the side, everything has to be done with risk management on level 1 of priority. In this example I just shared with you, the first thing I did is to add the stop order. So if I'm wrong, I know how much I'm going to lose. But the one thing you never want to do with futures and VIX is to have an order, long or short, and you don't have a contingency plan in place. Okay, this is no longer trading, and this now falls into the world of you can call it having fun, you can call it gambling, you can call it, you choose the name, but definitely that's not trading, and that's not serious. Okay, and again, I'm not saying anything new here, but I do want to mention it, because we traders love to trade and love the markets, isn't it? And I don't want anyone to get overexcited by this, and next thing you know, you are not managing risk. That's priority number 1. Key takeaways from today, there are many, but one thing I would say, for example, that probably you didn't know before the webinar started, is the fact that volatility is an asset that you could trade. Many people think of gold is an asset, stocks are an asset, Bitcoin is an asset, Silver is an asset. Maybe crude oil or FCPO is an asset. And people used to think about those things, but people don't think that volatility is an asset too. You could trade it, and actually is diversified, is adding diversification, right? So it's a very good instrument for you to learn and to understand that it's tradable. It's not something that someone says when things are bad out there and they say the market is volatile, and that's the end of the conversation. A smart approach to volatility is to look into the VIX and you can trade it. Futures is what enables us to trade the VIX because we trade VIX futures, technically speaking. Strategy dictates the success. Okay, so don't improvise it. Just do some study and some practice first. And discipline is paramount. Please manage your risk. Okay. So I have a few QR codes here to share. We are about to take the questions now. I'll be happy to answer any question you may have. I'm here for you, even though we just hit the top of the hour. I'm happy to stay a few extra minutes if you need me to. And so please let me know. And in the meantime, I will leave this on the screen. And also, William, I'm all yours, my friend. If you have any question for me, I'm ready to listen.
Okay, Mr. Jose. So I guess I will be taking over from here. So we have just two questions over here. So basically, this the audience, Mr. Wong, asking that he says, for the Bollinger Band you shared just now, do you adjust the moving average time frames like to how many days, or is there any specific time frame for that? Like, do you adjust the Bollinger Band to any time frame, like 10 days or 15 days?
To be honest, this is all about your methodology. Any adjustment that you do on an indicator could be any indicator. I'm just going to go back to the Bollinger Band setup I had before. Let me get my screen in order. One sec. I just need to do this. Here we go. Delete the drawings. Here we go. So this is a daily time frame, and this is a Bollinger Band using 20 simple moving average. Could you change these and make it, let's say, 3 standard deviations instead of 2? And now you're going to get less trades, but the ones you get may have the probability to be more precise because it's more extreme. Because instead of a 95% probability of being inside, 5% probability of being outside, now you have 99% probability of being inside and only 1% probability of being outside. So it's more extreme. So can you do things like that? Yes, of course. But again, you always have this balancing act with indicators. All of them, by the way, always have this balancing act. The more impeccable your settings, the less trades you get. And the less impeccable your settings, the more often you trade. So the question is, what do you want to do? And also, who makes more money? A trader that takes maybe 1 trade a month and is almost always profitable, but is only 1 trade a month, or a trader that takes 2 trades a week, but sometimes get a stop out, but he's trading 2 times a week. So maybe the more active trader ends up making more money, but it really represents that you also want to take that extra level of risk, and it's okay with your personality and your mindset and your personality traits. So there is no right or wrong when it comes to selecting indicators. It's just that you need to do your exercise to change the settings and do some back testing and see what you like and see what works for you. And also know that as markets change conditions, those settings will start making no sense at all. If you adjusted the Bollinger Band perfectly well, and it worked very well before the pandemic, well, let me tell you that when the pandemic started, all those settings were thrown out of the window because the market condition was so severely different that it doesn't even matter that you spend time adjusting your indicators. So my favorite way to use indicators is I just use standard settings. That's it. Now, do you like to adjust them and that works better with you and you do your exercise? It's totally fine. But it's always this balancing act. The more perfect you are, the less often you trade. The less perfect you are, the more often you trade. So if you manage the risk properly, who makes more money? That's a question for you to answer.
Okay, thank you so much, Mr. Jose. So I hope they answer your question, Mr. Wong. So there will be just one more last question from this Mr. Lau Kyung Ki. So the client is asking, is there a specific VIX number like 20 or 35 that you consider is the danger zone where we should immediately start playing the defensive style?
No, there is no specific number, and I would even say that having a number like that would be very dangerous. And here's why. If we look at the VIX, I'm going back now many years, okay? Oh, sorry about that. I'm just using the, sorry about that. I'm using the wrong symbol here. So if I'm going back in time, many years, okay, 1990, okay, all the way to the 90s. So you could see that there are times, let me try to get something like this on the screen. So there are times where low in the market is that level, 895, and a high level of volatility is, let's call it there, 17. Okay, and there are other times where low is there, 17, and high is maybe here, 35. Okay, so this was the period from 1998 to 2002. This is the tech bubble crash. Okay, the tech bubble crash. If we are looking at what happened after the tech bubble crash, low was 8 and high was 17 again. But then there is another period of time where low is more like 16 and high, I'm going to put it there at 39. So you can see that this is what we call regimes, okay? Market regimes. The market changes beyond cycles. There are market regimes where the market conditions are totally different. And if someone told you that 13, or sorry, what was the number? 18, 17 was high, okay, on another market condition, okay, like now, low is actually 15, right? So what was high one time is now low. You get my point? So having a number in mind makes no sense. The one thing that you should do is to analyze the market and be more dynamic about understanding the current market regime in which you are in, which for me to do this, I use, as you saw earlier, I use UFOs, okay? And this allows me to understand better, what is high and what is low in the marketplace. Okay, you can use classical technical analysis, support and resistance. You may even go ahead and on a weekly time frame, maybe you throw a Bollinger Band. I'm giving you alternatives here. Okay, you throw a Bollinger Band on a weekly time frame, and now you know that 29 is high, 20 is mean, and 10 is low. You know what I mean? But now you have a reference that is changing through time instead of a static reference where for the rest of your life you will believe that VIX 20 is too high, right? Where there are times where VIX 20 is not high at all. Okay, so you have to be dynamic, just like the markets. They are an alive animal, and therefore we need to be dynamic with the markets. We cannot be that static.
Okay, thank you, Mr. Jose. Yes, that will be the end of our Q&A session. So once again, thank you so much, Mr. Jose, for your wonderful and insightful sharing. Although some people they view the VIX as a very niche product, but then it can be very useful for refer and to trade when the time comes if you know how to use it to hedge against your portfolio. So thank you so much, Mr. Jose. So okay, so I will be taking over from here, Mr. Jose. So
Wonderful. Thank you so much, William, and everyone for attending. It's a pleasure.
Okay, thanks, Mr. Jose.
Bye-bye.
So okay, so that will be all for today. So thank you so much, everyone. So really appreciate everyone for your time to join us tonight, and thank you again to Mr. Jose for your sharing. So we hope to see all of you again in our future events. So thank you and good night, everyone.